Hello, good afternoon, everybody. I'm Martin Sherwood. We're just waiting for a few last-minute people to join us, so maybe another 60 seconds if you can bear with me. Thank you so much for joining us already. Okay, well, I think we should make a start. This is Martin Sherwood speaking from Enterprise Investment Partners. Good afternoon to you. Thank you very much indeed for joining us. I'm just going to give you an idea of what we're going to be doing this afternoon. So we've set aside 30 minutes all up. So 20 minutes is just going to be a discussion on what we think is happening in the tax efficient market at the moment. That's to say EIS, SEIS and BPR. So a few trends and a few ideas for you. Then a brief introduction to Enterprise Investment Partners, who we are, for those who don't already know us. And then we're going to be moving on and looking very briefly at 6 different products which we are showcasing this season. So moving swiftly on then, there is a risk warning for you, which I'm sure you're all used to. So first of all, a brief little overview of what we think is going on in the market. Before doing that, I just want to say that I'm assuming everybody understands what the tax reliefs are. I do not propose going into those in detail. I think you're all relatively sophisticated. You understand EIS delivers 30% income tax relief, SEIS is 50%, and BPR, short for business property relief, provides exemption from inheritance tax after 2 years of owning the shares. So delays to the advance assurance process. So this is an extremely important trend in our marketplace at the moment. There is currently a consultation going on with the HMRC, and the EIS Association and various parties have already submitted their submissions for how they think the process could be improved. Long story short, there are huge delays in people receiving advance assurance. This has become a sine qua non now in this industry, so no offers really are launched where there has not been an advance assurance from the revenue that the scheme will qualify or should qualify. So the market is increasingly relying on advance assurances, and the result of that is that there's been an enormous increase in demand, and the resources at HMRC end have not kept up with it. So that's a major problem. It's led one of the major providers recently to announce they had to stop receiving money because there was such a backlog of money that had built up waiting for advance assurance process to take place before shares could be invested. So this is having an enormous effect on our market at the moment, so it's something really to look out for. Now, in addition to that, just a few things that I think you should be looking out for when contemplating investment currently. Not just whether the business or the investee companies have had an advance assurance, which is necessary, but also how soon will your money be deployed? So how soon will your shares be issued after you send your application in, and how soon after that will your money actually be invested in the thing that you're investing in? So I think that's an extremely important consideration, and increasingly there are rumors of large amounts of money being raised and delays in actually investing those monies. Then of course, once your shares have been issued and your money has been invested, how quickly will you be getting the EIS 3s? So in a word, before a company can issue an EIS 3 certificate for tax purposes, it must have been carrying on an EIS qualifying trade for no less than 4 months. Clearly, offers on behalf of companies which are already trading and have that for at least 4 months are going to be able to issue tax certificates a lot sooner than new companies that have not yet started to trade. So that's a very important consideration. This afternoon I'm going to highlight a number of our offers where the companies are already trading and therefore they are able to issue. Now, the final consideration obviously is the exit. A lot of people always ask me, how prompt will the exit be? So how quickly after the expiry of the 3-year EIS term will the exit take place? And that's an extremely important aspect. Back in the banking recession, of course, exits were terribly delayed, and they were typically up to 7 or 8 years. I think they've now recovered, but it's still a very important consideration. Okay, so that's our little brief overview. I now want to introduce you to Enterprise Investment Partners. This is a business that I co-founded with Christian Elms 6 years ago. It's a very small business. We, however, come from a large company background. We were previously in a big city firm, and I myself have been in this industry over 30 years in large firms. I was also founder of the EIS Association, which is the trade association for the industry. When we set up 6 years ago, we realized that we were going to have a few things that differentiated us from the rest of the market, and I think those can be easily summed up by this slide. So we believe in staying with the money throughout the process. That's to say, we raise the money, we manage the money, and that means a high quality investor relations service, and we exit the money. We're just in fact on the point of exiting producing our first exits from our first offers 5 or 6 years ago. So that's happening right now as we speak. About 2 or 3 years from now, we think we'll have a good half dozen exits under our belt. So that's the exits. We also believe in being highly transparent in everything we do and in all the information we provide. And that's best summed up by saying that we believe in being the complete reverse of a blind fund structure where you have a glossy brochure, but an investor has not the faintest idea where his or her money is going. We think it's very important investors should understand where their money is going, and as far as possible, we always tell them. We introduce them to the managers, we invite questions, they can see the projected returns, etc. So they can kick the tires, if you like, before they make the investment. They can ask as many questions as they like during the term of the investment. So it's a full service, transparent offer. And last but not least, we believe in only engaging with top caliber asset managers. So all the people we work with who are the asset managers to our funds, we believe are top draw, top caliber in their own industries and have got a really good track record to prove it. Okay, let's move on. We're going to be showcasing 6 products. 2 of them are EIS funds, 2 of them are EIS single companies, 1 of them is an SEIS fund, and lastly, we have a business property relief, a BPR offer. So first up is the Hindsight Media EIS fund. Now this is a fund which is seeking up to 25 million, diversified across film, TV and video games, working with some extremely experienced managers. It's a capital preservation scheme, which means the downside is protected, and I'll explain in 2 seconds what that means. We're also looking for a prompt exit from this, and the reason that we can do that is that we can wind the companies up quite quickly after the investments in the productions have been made, simply by selling off the residual rights to the productions and winding up the businesses and liquidating them. So diversification, as I mentioned, across film, TV and video games. Not many offers in this sector of the EIS market offer so much diversity. Secondly, the manager has an outstanding track record, having converted 27 million to over nearly 32 million across 22 projects. Now, some of those were EIS qualifying, and the average return from the EIS qualifying projects was 120 for each pound invested. Now, the most important aspect of this offer is the capital preservation, as I mentioned, and that is achieved by effectively offering downside protection through a combination of EIS tax relief, working with the production credits which are available for film, TV and video games productions, and also combining that with the benefit of pre-sales. So what we're doing is we're, if you like, guaranteeing or fully protecting 70% of your investment. The remaining 30%, of course, is represented by the income tax relief. So the 70%, which is not income tax relief, is downside protected. The target returns are based on a number of assumptions, which we've got and we can let you have if you're interested. And there's a low, medium and high case. The medium case target return is £1.20 for each £1 invested, equivalent to an IRR of 18%. Moving on now to our next fund, which is the Imbiba Leisure EIS fund. We've been working with Imbiba now for quite a few years, as many of you, I think, will know. This is categorized as a growth with asset backing. I should have mentioned earlier on to one of the leading commentators in the industry has identified that there are effectively three types of EIS in the market this season. Firstly, capital preservation schemes, and the media one we've just looked at is one such. Secondly, schemes which offer growth but have a degree of asset backing. And thirdly, schemes which are super growth. We'll come to that in a moment. So Imbiba Leisure Fund is denoted as a growth with asset backing. You're probably saying to yourselves, what is the asset backing? Well, the fact is that we're working in the central London leisure industry, bars and restaurants. We're taking long leases in central London properties, typically 25 years long, and they, of course, have a distinct value. So if we're exiting these businesses after, say, 4 years, we will still have an unexpired lease length of something like 21 years, which is extremely valuable indeed. So that is the nature of the asset backing. We'll come in a second to the track record of Imbiba, which is quite outstanding. Target return here is higher than the media one. It's £2.50 for each pound invested. And we've got 3 projects that are already operating companies, so they are available still for investment, and that means that we'll be able to issue shares very quickly and, of course, issue tax certificates very quickly as well. So diversification, Imbiba have been investing in bars and restaurants for over 18 years now, and they've built up an absolutely stunning track record. I'm going to come to that in a slide after this. There's an alignment of interests, which is really interesting. Not only do we, as their strategic partners, we're required to invest in each of the investee companies ourselves, but also we have a leading hurdle rate for management incentive purposes. So that's to say we do not touch the management incentive until investors have had back £1.50 minimum for their pound invested. We're looking at a track record which is phenomenal, really. It's 14 million is being converted into 38 million. I'll come to that in the next slide. And we're also, as I mentioned before, looking at very prompt EIS certificates. I should have mentioned at the beginning of this webinar that if you have questions, there is a chat box down the bottom left-hand corner of the screen. I'm sure you're all very experienced chat boxers. Anyway, if you have a question you'd like to log, please put it in the chat box, and my colleague will retrieve it, and we'll look at that when we come to Q&A at the end. Now, this is the track record slide I wanted to show you. So this shows the performance of the central London Imbiba businesses over the last 15 years. If you work from the bottom upwards, you will see that Smith & Jones in 2000 exited with a 2.2 money multiple. Thomas & Carter 2.3, Lewis & Clark 3.7, and Drake and Morgan in 2013 5.7, which is a quite phenomenal return on a City of London. We got involved with Inbibra in 2012, and we funded the last 5 companies up to about £7 or £8 each. We're still funding the last 3, and there's a new company about to pop in very soon. So it's a constant succession of new investee businesses. So Inbibra is highly recommended. I'm going to move quickly on now to our next offer, which is a single company EIS offer, but an extremely interesting business. CERU is the brand name is actually based on cerulean, so it's all about the Eastern Mediterranean and about that type of cuisine. So a fusion, if you like, between Greek, Cypriot, Turkish cuisine, and so it's extremely popular with young people, very healthy, and a really interesting new concept in the casual dining market. We've got £1 million raised already for this, and we're looking for a further £1 million. What we've done so far is we've successfully created a series of pop-ups around London over the last year, and we've just recently, about 2 months ago, opened the first permanent site for CERU in South Kensington, and that's a picture of it there. It is trading phenomenally well. The social media and the reviews have been ecstatic, and I can show you those. They're available on the CERU website. So it's a spectacular success story. Now we're looking for a further £1 million to fund the next 2 to 3 outlets. The key reason I think that this is recommended to you is that we have an outstanding management team here, headed up by Stephen G, who is very well known in the UK restaurant industry. He was founder and chairman of Carluccio's restaurants and has consistently made money for all his investors over the years. So highly recommended offer. Proven concept, as I mentioned, incredible management experience from the chairman to the chief operating officer. There's limited competition in this new style of cuisine, and the business is already up and running, so we can provide prompt EIS tax certificates. So that's CERU. Now moving on to wine, which is the second of our single company EIS offers. This is actually a capital preservation scheme, because what this is doing is buying and selling fine wines. So it's trading fine wines, a bit like a stockbroker trades stocks and shares. So it's buying and selling the whole time, making profits, margin profits on purchase and sale of fine wine lots. So very experienced operator based in the West End, and they've been going quite some time. They've got a really outstanding track record. Wine is somewhat of a unique asset class. It's has very low correlation with other asset classes. The asset manager's track record is really outstanding and has consistently beat the fine wine index over the years. Again, this business is already trading and therefore can issue prompt EIS certificates. So that's wine. Moving on swiftly, we have an SEIS fund, which is called Epicure, and that's going to be investing in food and drink products. This is called a super growth scheme because there's no asset backing. The investment is limited, as I'm sure you all know, to £150,000 into each single company. It relies a lot on the nurturing and support that the managers can give to these businesses. Track record, we're working with the Asset Managers Startup Funding Club, who've been in the SEIS market since SEIS was introduced back in 2012, which is some 5 years ago, and they are extremely experienced. And this, I think, is the 5th fund that they've been involved with. They have got a whole coterie of mentors and advisors to help the entrepreneurs with their businesses. And we're also supported by two very famous names, one called JC Deco, the advertising company. Their scheme is called Nurture, and Tesco's, their scheme is called Back It. So in a word, JC Deco offer free advertising space to these startup businesses, and Tesco offer free shelf space to trial these new food and drink products. So the food and drink market is particularly interesting and is extremely well documented. It is a huge market, as I'm sure you realize. So that's a really interesting offer in the SEIS space with a full support base of monitors and supporters and nurturers. So that also is recommended to you. Now, moving on, last but not least, the sixth of the products that we're showcasing this afternoon is a joint venture with GUINNESS Asset Management, and we've been working with them for a year now. And this is a business property relief scheme. It's investing in solar projects, and that they are still allowable through BPR, although, of course, as I expect you know, they're no longer possible through EIS or SEIS. So the particular speciality here is rooftop solar schemes. And what does that mean? Well, that means that GUINNESS, the manager, the operator, they go along to the manufacturer and they propose putting solar panels on the roof of the manufacturer's factory, and that will have the effect of dramatically reducing the cost of power to the manufacturer. Certain industries are extremely power intensive. The automotive industry is a perfect example, and these solar panels can dramatically reduce even half the cost of power to the factory owner. So it's a deal which satisfies everybody. So just a little bit of background on this product. So it's capital preservation with income. The minimum investment is 25,000. There are quarterly closings, so every quarter people can come in or they can go out, so there's a liquidity event, if you like, every quarter. Target return is a 5% annual return. So interests are aligned, and the big story here that I'd like to convey to you this afternoon is that there are no upfront fees when you invest in this offer through an advisor. So if you're investing through an advisor, there's nil fees upfront to pay, which is an exception. And then very low ongoing fees, only 1% annual management fees going forward. Performance fee only applies if returns of a minimum of 3.5 per annum are achieved. So it's a capital preservation scheme primarily, but it also provides income, so it's extremely safe. You're locked into the government subsidies like feed-in tariffs and ROCs, etc. There is liquidity every quarter if you want to provide an income or you want to sell your holding completely. And there are a pipeline of projects available for investment. So if you invest in this, your money will be very quickly deployed, which I think is an important point. Good. Now we've reached the sort of 20-minute mark. Do you have any questions and answers? My colleague is just going to be joining me. He's going to be pointing out some of the questions that we've had, which I will read out. So one question was from Nico. The £1.20 per £1 invested, is that including or excluding the tax benefit? So it's after the benefit of tax relief. So that's the net effect. So if you invest 10,000, you can expect 12,000 back. Yes, that's correct. So you get £3,000 tax relief, and you get £12,000 net back, free of tax, obviously. Stuart has asked a question on hindsight. Should hindsight give EIS 3 certificates in 16, 17 or next year? The answer to that, Stuart, is that we are intending to issue the shares this year, so therefore we will be able to, you will be able to get tax relief in this year, or indeed carry it back to prior year. Nico again has asked at what price you invest in BIBA and CERU as they are ongoing businesses. That's an extremely good question. And yes, there have been share premiums applied to both the Inbiba investee companies and to CERU. So we're on about the third round of investment in CERU now, and the shares are a little more expensive than they were at the outset. So obviously there's a time cost here. People who invest at the beginning are the ones who get the best price. And how do we determine the price? Well, we determine the price by what we consider to be the worth of the business. So if it's open new outlets which are starting to be profitable, then obviously it's worth more than when it had no outlets at all. So it's really at what stage in the business your shares are issued which determines the price. Now, I just wanted to let everybody know before we break that we will be sharing this presentation and a recording of the webinar with you. So if there's any part of this webinar that you can bear to listen to again, it will be available to replay. You may well have further, more detailed questions. I've tried to run over the material extremely rapidly this afternoon. If you have more questions, we'd be delighted to answer them. I'm not sure how many more questions we've got. It's 27 minutes past 2 at the moment, so that's pretty neatly tucked into 30 minutes. Any more questions? Nico, at what point will the money be deployed by Inbiba? When do you expect them to hit their target raise? So Nico, so the money will be deployed in the businesses immediately as soon as the shares are issued, and we are expecting to reach our target raise before the end of the tax year. So we think we're going to probably be closing Inbiba sometime in March. That somewhat depends on how quickly we go in February, but demand is looking pretty brisk at the moment. So, are there any more questions from anybody? Yeah, 2 seconds. Just waiting a few minutes in case any further ones. One more question. Thank you. Yes, Nico, you do know the price when you invest. We will tell you. So there's no secret about that. It's all part of our transparent approach. You can ask as many questions as you like. So we can give you the share prices, which reflect the variable maturity of the 3 businesses that we're going to be putting your money into. Okay, well, listen, thank you everybody for joining the webinar this afternoon. I hope that was helpful. It was extremely brief, but let's hope that it stimulates some further questions from you. 2 more minutes, my colleague is saying. Maybe there's some more questions. So just hang on a second before we close. So I look forward to hearing from some of you later about your further questions, reactions, comments, whatever. I hope you found that interesting this afternoon. What was the question?
2 seconds, please. Just getting on 2 seconds.
Bear with us, we're just getting the question.
So be interesting to know the premium differential from pre-revenue to post-revenue break-even.
Is that Nico again?
That's Dominic.
Dominic. Well, I think we should do that offline,
okay.
Not on the webinar. So Dominic will come back to you on that very shortly this afternoon.
Okay.
All right.
And then one last question.
One last question.
Chris, so target returns seem to vary massively between EISs. Does that signify risk?
Chris, target returns vary dramatically. Yes, it does signify risk. So in Inbiba, what you've got there is trading risk. So the ways we mitigate that risk is by working with the Imbiba team, who've got this phenomenal track record. That's not to say that the returns are always going to be as good as they have been, but there's every likelihood that they should be similar. So there is inherent trading risk. Now, in something like the hindsight media, of course, you've got a downside protection device. Effectively, by combining pre-sales and production credits, you can effectively totally protect the downside, the 70%, which is not income tax relief. So the returns are not as high. So it's capital preservation. And capital preservation schemes typically don't have such high returns. Any more questions? No? So we'll say good afternoon, close it there. Thank you very much for your attention this afternoon, and we look forward to picking up any further questions from you. Thanks very much indeed, everybody. Thank you. Gone?